I just want the predictability. I don't know where rates are going to go. Feels like they're really, really low. So in my opinion, the only way they can go is up. I never thought they would go up as fast as they did, but it put us in a really good position.
You're listening to Ice Cream with Investors, a podcast that is dedicated to teaching you how to better invest your money so that you can live a more intentional life. I'm your host, Matt Four, and it is my goal to teach and empower you to remove the roadblocks to your financial success.
All right, Jered, welcome to the show.
Matt, thanks for having me. I appreciate the opportunity to be on the show and share a little bit about my story to the listeners.
You got it. You got it. Well, you know we like to start with the difficult questions here. What's your favorite ice cream?
I'm a Cincinnati boy, so there's a company in Cincinnati. Maybe your wife's familiar with it. Grader's ice cream. So I'll go Grader's black raspberry chip.
Yes, I'm very familiar with Graders, and they are known, I feel like, for their like random flavors. Like black cherry chip is not something I feel like you walk into a local Baskin Robbins and see, but like we love eating at Graders whenever I go up that way.
Yeah, it's like guilty pleasure of eating ice cream, but it feels like it's at least real ingredients, right? Like, yes, I'm downing a ton of sugar, but at least it's like real sugar and not like some chemical, So.
Yeah. Now I ask everybody that's from Cincinnati on the show as well. Are you a Skyline fan or no Skyline?
I'll eat Skyline. I mean, it's not like I'm a pretty like disciplined person in my nutrition, and so like I'm not a big eater of Skyline, but my kids like it.
Yeah. Well, just to publicly state, I am not a Skyline fan. It just tears up my stomach because maybe I'm a Nancy boy from not Cincinnati. So anytime I eat that chili, it just tears up my stomach. Well, tell our listeners, what's the scoop? What do you do today?
So I'm a multifamily owner operator in Cincinnati, Ohio. We have 1,400 apartments, and I heard just earlier today that we're the 5th largest landlord in Cincinnati. I've been doing this for 16 years, and this is all I've ever known straight out of high school, kind of doing this type of business. And we use syndication to further that core competency of being an owner operator of multifamily assets.
Nice. Well, take us back. You said right out of high school, where did your real estate journey begin?
Yeah, it actually began before the exit of high school. So I was not a great academic student, but my high school had wood shop, and I was really good with my hands and just had a natural aptitude for wood shop, and which evolved into natural aptitude for the trades. And so I was glad my senior year, our high school had a program where I could work full time. Using my kind of skill set in the trades and natural aptitude to be able to fix things, I became a maintenance tech for another landlord here in Cincinnati, Ohio, where I was the guy, changing toilets, hanging blinds, doing whatever the apartment needed, and figuring it out along the way. And shortly after high school, myself and my brother started a construction company. You can call it that. It was basically like fixing homeowners' houses, which evolved into doing like kitchens and bathrooms and putting additions on homeowners' homes. And we just kept saying yes and kept watching YouTube and learning, and again, just had a natural aptitude for it. But around 2008, we looked around and said, hey, we have a skill set to fix up distressed houses. Why don't we buy some of these foreclosures? And so graduating high school in 2008, came out, started buying foreclosures with the little bit of money we saved, substituting our lack of capital at the time with sweat equity, and started in the single family house space. That evolved over a couple of years to duplexes and quads, which then buying 10 unit buildings, buying larger 40 unit buildings, and now today focusing exclusively on large 100+ unit apartment communities.
That's amazing. So you mentioned a little bit of lack of capital and sweat equity. Where did you get the capital kind of do those first few deals? Was it the money you saved, private money? What did that look like?
Yeah. So in high school, I was fortunate to be making a whopping $15 an hour, which at the time it was pretty good, right?
Way more than I made in high school.
Yeah. As a maintenance tech, right? $15 an hour, full time, living at home with my parents. So that was enough. And plus my brother was doing the same thing, being a maintenance tech. And so him and I are business partners today, but we were able to save up enough to put a down payment on a 6-bedroom house in not so great of an area, where him and I lived in 2 of the bedrooms. We rented out the other 4 to friends. It was basically like a frat house, but we owned it and lived there. And then when we were doing kitchens and bathrooms and additions on homeowners' homes, that business really grew quickly because we did a good job and word of mouth spread. And so we might do a high end kitchen and make 25 grand and then turn around and buy a very distressed house. Again, this is 2008, 9, 10, right? This is a
Hmm.
different time in the market. But in Cincinnati, Ohio, you could buy a house for 25 grand. And so we were buying heavily distressed house. We did not have W-2 jobs, and this was at the depths of a financial crisis. So no bank was lending to us. So we had to buy cash and renovate cash for our first 8. And so that took us about 3 years to get 8. And then we were able to get a cash out loan from a local lender to strip the equity out of those 8. And the wise move we made was to go buy 10 more houses and let the snowball start to roll.
How did you even get the idea that this is something you should do? Were there other people in the industry that you saw do it? Did you have mentors? Were your parents just big real estate tycoons? Like, how'd you get the idea at 18?
So no one in my family is entrepreneurial. My mom was stay-at-home mom. My dad worked a corporate job for 30 years as an accountant, but they were always super supportive of me and my brother. Neither me or my brother were ever on, call it like the corporate America track, right? We weren't good students, and so it was never really like we just. A lot of people talk about the mindset shift to get into real estate. We never really had to shift our mind because we never really were in the other mindset. So we were just
Yeah.
coming out saying, well, we're smart people. We just don't like this traditional path. We're really driven people. What can we do? And it's like, oh, well, we've been working as a maintenance tech and we understand how our skill set in the trades would complement real estate. And then we were always just attracted to that consistent, predictable stream of income. And so it wasn't this grand plan that we sat down and I was 18 years old and we mapped out, but it was like, we have a skill set. We know how we can use that skill set to try to make some money. And then over the next 16, 17 years, we've just been polishing that and getting better and better and better at operating our business, which is the same thing we were doing, 16 years ago, just at much larger scale.
I'm so glad you mentioned that about not really having a plan. I mean, I talk to a lot of people in this industry that, I'm going to get in when the real estate market does X, or they start planning out. And the next thing you know, 2 years from now, they're still in the planning phase of what they're going to do in the real estate business. I have a firm belief around get going and then get good. I think you have to understand kind of where the end direction is, but you're never really going to understand what works, what you're good at, how to maneuver around things until you're actually in the business and working in it. And that seems to be something that you guys followed and have been successful for you.
Yeah, I think in the beginning that's really reasonable, and you don't know what you don't know, so you just got to get started to figure out what you don't know. Um, my obviously the responsibility shifts over time. We have over 50 employees now, and so like part of my responsibility is to cast that vision, is to have that plan, is to be forward thinking. And so it's definitely changed over time. Now I have a significant more content to base my decisions off and base my planning off, and I have a lot more responsibilities to make sure we're setting a path forward.
Yeah. So at this point in the story, you've got about 18 units. You're 5 to 6 years into it. When did you start getting involved in like the multifamily space? Were you looking for distressed assets and foreclosures in that space as well? Or how'd you kind of get into that?
I guess it depends how you define it. So it was probably year like 2 or 3 when we started getting into like duplexes and quads. Um, it was probably around year 7 that we made a pretty big jump and bought a 42 unit, buy it with ourselves, no investors, and that was a multi-million dollar transaction that we were able to reinvest cash flow that has kicked off of our existing rentals or equity that we've stripped through debt restructuring. But we actually had been gravitating towards that because we really liked the consistency and the predictability and the standard operating procedures we could drive into larger communities, especially from the construction side. Renovating the same unit 40 something times is quite easier than renovating 40 different houses. And so we were trying to get there and actually to generate the cash to be able to buy this large community without any investors. We didn't have enough funds just from our rental portfolio that we've been building. So we went out and bought in one year, we bought 17 houses and flipped them doing all the work ourselves to generate a huge pop of cash to then go out and buy this first apartment community, which we did, and we renovated, and we executed our plan, and then after we had forced the appreciation, we stripped the equity out through a debt restructuring and kind of proved out our model. And then around year 8 shifted into the syndication model. So first 8 years we used only our own funds, and then the last 8 years we've been partnering with passive investors to raise funds to buy larger communities.
So we're what, year 2016 now, 2017 in your story? Is that about right?
Correct. Yeah.
Looking back at those times when you were buying that, I guess the first question I have is, you only focus in the Cincinnati market, is how were you finding the deal flow? And then how did you know that this is a distressed asset that just needs a little bit of love and we could make something out of it? Or this is a distressed asset because it's in the wrong area of the market and nobody's really going to be moving into this?
So I mean, deal flow and sourcing deals is a ever evolving target, and I would say is consistently a bottleneck in our company for growth. But it changes drastically, right? Like, so my answer in 2008, 9, 10 is nothing like it is today, and
That's
slightly
right.
different in 2016, right? So this deal that we bought, this 42 unit multifamily we bought in 2016. It was on market with a broker. It did not have as much distress as we typically buy today. And that was intentional, right? Like, we knew we were making a big leap and we were really extending ourselves financially to take this thing down. And so we didn't want to buy, a foreclosure that was fully vacant. We wanted something that was was already producing cash flow. And what we were looking for, I mean, this thing was built in the 1990s, kind of original finishes, but really great bones, and gave us the opportunity to go in and do what we know how to do really well, was like turn over those apartments and upgrade the things like cabinets, flooring, vanities, toilets, light fixtures, outlets, switches, things like that. So it's very predictable. It's a cosmetic renovation. We weren't, moving walls around or doing humongous capex projects. And so it was it felt like a big bet at the time, but it was a safe big bet.
Mm-hmm. Yeah, I mean, a 1990s unit is a lot different than a 1970s unit, and it's a heck of a lot different than some of the things in Cincinnati are 1890s and 1920s and those types of units. So did you feel more comfortable because knowing it's a 1990 unit? Or I guess help us understand, for new investors that are getting into this game, they're always looking at like, oh, it's cheap and the cash on cash and those sorts of numbers, they look great.
Mhm.
But I actually stopped somebody from buying an 1899 duplex one time because I'm like, listen, you don't have the construction experience to know what you're going to get into. And if you rip off the walls, chances are there's going to be a host of problems behind there. So you might want to think twice about that. I guess, like, is that what you mean by safe? And then give us some guiding rules around some of the older inventory that's in Cincy, how you would approach that.
Yeah, we avoid the older inventory, right? So there was a lot of years where we would buy that kind of vintage and crazy projects because me and my brother were the only ones working on it. And we had a very high skill set in the trades to be able to handle the unpredictability of whatever is behind a 100-year-old wall. Um, but as you scale a company and you're trying to build processes, we like buying cookie cutter assets. We don't want anything untraditional. And I even say today, the most ideal asset we could buy today is a 200 unit building built in the late 90s, 100 one bedroom floor plans and 100 two bedroom floor plans, and everything looks exactly the same, right? I like boring because it creates consistency and predictability. Um, the vintage of the asset across our 1,400 units today probably averages out about 1980s. So we do have a competitive advantage to know the construction and trades, and be able to handle kind of the challenges maybe 1970s, 80s assets bring to us. But it's not for everyone, because it does make it harder when you can't run to Home Depot and get the parts because they're just obsolete, or the tradesmen who worked on this property. If you go back to 1890, it's like, there has been 6 or 7 generations of hands inside those walls, kind of cutting and splicing things. And I mean, even around that vintage, they were using horse hair to, make plaster. And it's like, no one knows how to do plaster anymore. And so you're going to pay a premium for a very, very skilled tradesman to be able to work on your property because it's untraditional.
Gotcha. So what is your buy box today when you're looking at deals?
We're exclusive to the Cincinnati, Ohio market, so it's not like Cincinnati MSA, but it is Cincinnati's MSA, so it's not the city of Cincinnati, but mostly we're in the northern suburbs. We'll buy all over Cincinnati and the surrounding markets, but our competitive advantage is operations, and so the further we get away from home base, the more we lose that. So geographically, we're pretty tight. So that's the market. We're typically buying garden style, call it 1970s to 2000s. Um, I would love to say our criteria on unit count is 100 to 300. Sometimes we find opportunities in the smaller stuff too, and we have a really large community right nearby that we'll tack on. So right now we have 19 communities over 1,400 units, and so the average is a little bit less than 100. Um, but we're open to smaller assets, but yeah, it's usually something that has an ability for us to force appreciation. And that appreciation typically for us comes in two components. It's property management and construction. Usually it's both at some varying degree because we are vertically integrated. We have our own property management company and we have our own construction arm of our company that oversees the renovation of these assets. So if we can line all that up and make an acquisition, our typical business model is buy a distressed asset, improve the operations through renovations and just better operating of on-site operations through property management. And then around year 2 or 3, we'll restructure the debt and strip the equity that we have forced, and then continue to hold the asset for another, say, 7 to 8 years for roughly a 10-year hold period. And that's really what we started out doing with our smaller stuff. And we haven't really changed too much in our business model. We just do larger and larger each time.
So I would beg to say, since you are very geographically dense and focused on probably 100-mile radius, that you're able to tackle some of those smaller deals. I think a lot of people getting into the space, about 20 units you can take on yourself, but you're probably managing it yourself if you want really good efficiencies. The reason why you hear everybody in the multifamily space is say 100 units and above is because you can hire a property manager at that point. So a lot of people get stuck with these like 60 unit deals, 70 unit deals that we would pass on those because we don't have the scale to go vertically integrate ourselves to go take those stuff down. But if I lived right around the corner and I had a property management team that was managing 1,000 units in that same market, you could probably take that on and just bolt it onto your portfolio. So do you find yourself kind of being able to go tackle some of those, let's call it 40 unit to 80 unit deals in your market because you're so close and tightly geographically aligned?
Yes. And that's where the most upside exists over the past few years. So, take the last 18 months off the table. We've seen 15 years of a run up, up cycle. And so anyone who owns a 200, 300, 400 unit building is sophisticated enough to know how to capture that run up and that upside and the benefits that the market has given. That's a general statement. Obviously, you have some that you have mistakes, but there's a lot more in that, like, say, what you said, 40 to 100, I think you said, space, that there's inefficiencies in that market and there's mom and pop owners that are not operating as well, where with our economies of scale and our geographic cluster of units, we're able to come in and bring kind of that higher level efficiency into an asset that is challenging to run. And the upside is significant because of it. So we have been able to capture that. But you said 100-mile radius. I think ours is probably a 30-mile radius right now across our 1,400
Wow.
units. And
That's
so
awesome.
we break those 1,400 into 2 regions and 4 portfolios. So you're right. There's a cluster of 500 units that we can hire one property manager, 3 leasing professionals, and a team of maintenance of 3 to 4, and they're assigned to that portfolio. They work together, and all the properties are within 10 minutes of each other.
Yeah. Wow. That's awesome. I didn't even think that you could get that closely dense, like that dense in 30-mile radius. You mentioned vertically integrated. I want to touch on that for a second. So first, could you define that in case that's a new term for our listeners? And then second, did you vertically integrate from the start, or when did that start to make sense for you to do everything in-house?
Yes. So vertical integration is that we control the components of the operations behind the investment. So instead of hiring a third party property management company, we built the company and hire ourselves. And then from the constructions arm, instead of going out and hiring a general contractor and hiring tradesmen, we hire W 2 employees. We build out the standard operating procedures and we control that aspect of our business too. Right. So those are the two vertical integrations that we primarily focus on. Obviously, we're still working with vendors and partners like title companies and attorneys and things like that. We're not vertically integrated to the point where we don't work with anyone else. But those two main operational components we have full control over, and that's what vertical integration means to me. What was the second part of your question?
Just when did you decide to do that? Was that a conscious decision from day one, or like, hey, I got to this many units and saw that we could just do things way better if we just vertically integrated?
Yeah, that's a great question. So we were at probably about 20 units when we made this decision. And frankly, at the time, what we were really good at was the construction arm of the business, right? So going back to all the origin story and all that, like what we were really great at was finding a distressed asset, going in, doing the renovations at a very fast speed, and then placing a renter. And so at about 20 units, we said, we're going to hire a third party management company, right? We want to focus on construction. And once we get these things polished and looking good, we'll hand it off to the third party management company. They'll kick out the consistent cash flow and we'll just keep going buy new assets and build out a construction company. So our approach to doing that when we made that decision, and this is probably like 2013. Um, so our approach to doing that, instead of going and talking to the sales representative or the corporate office about like, hey, we have these 20 units, we'd like to give these 20 units to a property management company. Can you tell us why we should hire you? What we did is we found similar assets in our market to what we already had. And I just called them like I was a prospective resident, a tenant, right? And I was like, I want to tour the unit. And the at the time we had only like single families and small assets. And so the property management companies that were servicing those were so like the responsiveness was so bad. If we did ever get a tour, the lack of professionalism was just through the roof. And so after trying forever, we found no one that we were comfortable giving away our operations to because in my opinion, and this stays true today, the most important part of the investment is the operations. That is the make or break of the success. And so I wasn't willing to give it up seeing the results that were happening from third party management, specifically in that space of like smaller units. So we said, okay, well, forget that idea. We're going to build our own. And ever since then, we've just been building up our own property management company that services only our assets. I have no interest in managing for other people. It's the least profitable, least fun, most important component of real estate investment. So I just do it for me, just do it for our company. But we have really kind of honed that in as our competitive advantage. And obviously I'm biased in this, but a lot of people would agree like SNS, our company is the best operator in Cincinnati of multifamily.
Yeah, I think I don't want to breeze over the fact that you called people and were getting their firsthand experience. I mean, that is such a pro tip around working with a property management company or just getting an understanding if you're about to buy 200 units, how it's being managed today. And is there an opportunity to go fill up vacant space because property management companies aren't picking up the phone, call it back, and all that sort of stuff. So if you have a small portfolio and you're looking for a property manager, that's a good way to find a good one. If you have a large company and you're looking to just vet them, that's another good example is just calling them firsthand and experiencing it yourself.
Mm-hmm. Yeah.
You you've mentioned a couple of times around processes and operations. I agree with you that operations is a key component. I would almost say that what we've seen over the past 18 months in the debt market has definitely made me think that that could be a bigger portion of how a property is going to turn out than operations. But operations is super, super important. What are some of the processes and procedures you all have to run a property efficiently?
Well, that's a long list. But no, I would agree. It's the combination. For us, I feel fortunate that we made a wise decision in hindsight that we used almost exclusively long-term fixed rate debt. Again, our underlying investment philosophy is consistent, predictable cash flow. And so if you want consistency and predictability, for me, that meant long-term fixed rate debt. That combined with operations is, in my opinion, the bulletproof vest for recessionary environments.
Let me ask about the debt real quick since we're on that topic. Was that a local debt, like a local bank to Cincinnati or local credit union, or were you going out and getting agency debt with that? Like, what did that look like?
I mean, it's evolved over time, right? So the smaller assets were usually like little local lenders. And then as we've scaled, we went into regional banks. And then the majority of our debt today is going to be with agency debt, so Fannie Mae, Freddie Mac, those types of things. So we have bought deals. We bought a 256 unit foreclosure with 100 vacant units and no financials. So that requires a lender that has a ton of trust in us. We had to go to a bank, right? We had to sign a personal recourse on that. But as soon as we got it up and running and polished, we can then refinance out into a stabilized non-recourse loan like Fannie Mae or Freddie Mac.
And then were you able to fix the debt because you just had this 10-year, 10-year vision on this? Because I think a lot of people that were buying deals in 2020, 2021, they were selling assets they bought in 2017 at a ridiculous profit. And they said, oh my gosh, if this trend continues, then I don't want to have to pay the prepayment penalties on the back end of these. And so let's just float it and wipe those penalties out. And now they're getting stuck with those assets at much higher debt costs than they predicted. So I guess talk me through, like, that was a very wise, smart decision on your point, looking back at it. And I'm super envious of you for making those decisions, but I'm interested in kind of the thought process behind that.
Hey, fellow investors, before we dive into our next segment of the show, I wanted to take a quick moment to talk to you about a fantastic opportunity for you to invest with me. As you know, here at Ice Cream with Investors, I'm passionate about real estate investing and helping you navigate the exciting world of wealth creation through real estate. And that's why, for the first time, I'm thrilled to tell you about an opportunity for you to invest alongside of me. Over the past 3 years, I've been investing in multifamily, mobile home parks, car washes. I've even become the bank and lent out money to fellow real estate investors on a short-term basis. And now you can come join me. If you would like to jump on a call and learn more about this opportunity, head to icecreamwithinvestors.com/invest and find a time for us to connect. And now back to the show.
Yeah, it's the underlying philosophy, right? So consistent, predictable cash flow. We weren't chasing the quick flip. We wanted to hold these assets. And if we do want that consistency and predictability, it comes with a fixed rate. And I might get a little bit into the weeds here, but I'd love to share, because probably one of the best decisions we made from a debt perspective was from 2020 to 2022. We used exclusively swap loans. I don't know if you're familiar with that product.
Yep.
But so what we did was we went to a large regional bank and they said, we'll lend to you, at that time it was like floating at 3%. And we said, it's great, but we want consistency. We want predictability. We'd like to execute a 10-year swap. So they take it out to the derivatives market, and some massive institution like Wells Fargo or, Chase or somebody steps up to the plate and says, I'll pay that floating rate loan at 3%, but you have to pay me 4.5%. And we're like, 4.5% fixed for 10 years, deal, right? So we wanted the predictability. So we locked in a lot of swaps from 2020 to 2022. And for us, it was like, we just want the predictability. We want the long-term fixed rate loan. We're okay paying that premium for 10 full years. Well, in hindsight, rates shot up. And if you're familiar with swaps, once that Wells Fargo is still paying that floating rate loan that is now today like 8-9%, we're still paying 4.5%. So they're losing money every single month. They don't like that anymore. It's what's called in the money. And so now we can break loans and get, for simplicity's sake, a prepayment penalty in reverse, right? Mm-hmm. So we did, we had I think it was a $7 million loan on one of our communities. And we broke the loan from the swap, and we had a $1 million breakage to us on a $7 million loan. So we paid a minor premium to go from that swap loan into a Fannie Mae 10-year fixed rate loan, but we got $1 million breakage to us. And so we did a ton of swaps from 2020 to 2022.
So that might be new to some of our listeners. Can you compare that with like an interest rate cap loan then? Because I think that's what a lot of things I saw come to market during that time was, oh, we bought an interest rate cap, but
Mhm.
the devil's in the details, right? Hey, that's a 2-year interest rate cap that has a premium that comes up after 2 years, and you all swapped the loan. So essentially you didn't have that, is what I'm hearing. Is that correct?
Yeah, and we swapped it for the full term of our business model, which was 10 years. So I have never bought an interest rate cap, so I might be the wrong person to ask, but I see it as an insurance policy, and
It
that
is.
insurance
Yep.
policy has an expiration date. And if you don't line up that expiration date with the end of your business plan, then that's where a lot of people got stuck in a pinch. So, I mean, we could have easily done, say, I don't know, 2 year swaps, 3 year swaps. We didn't, right? We did really long term swaps. And you have to put yourself in the perspective of these large institutions that are losing money every single month because they did that. They made a bet. It's basically each party made a bet. Interest rates are going to stay the same. Interest rates are going to go up. I really didn't care. I didn't think I was going to be using these loans as an asset. I just wanted the consistency of the fixed rate. Um, and then we stumbled into this, massive asset that we had in our loans because of how rates have gone. But yeah, interest rate caps are going to be more of like an insurance policy to say if it moves, it can only move this much, but I'm only going to have that assurity for 2 years, 3 years, whatever you pay for. And a lot of people did that because the lender required it, but it just wasn't enough.
Yeah. Yeah. Well, and I think what we're seeing too is what you bought in 2021 as an interest rate cap for 10 grand is now
Yeah.
costing 1.5 million or 2 million to go repurpose that because to your point, somebody is taking the other end of that bet. So
Mhm.
what it really is when I say, hey, my interest rate cap is at 5 and debt has risen to 9, they're paying the difference because
Mhm.
you gave them that $10,000. But after 3 years, they're going to say, hey, if you want another year, I'm going to price in that I'm going to be paying 9 at that. So, yeah, it's an insurance policy that has an expiration date on it.
So that same kind of give and take of like what the future of interest rates look like and where interest rates go, like a lot of real estate investors experience the pain of interest rate caps expiring and what it would cost to renew them, and that's just an exchange of value to assume risk. But on the swaps, we were the beneficiary of that. That instead of
Mm-hmm.
the cap going from 10,000 to 1.5 million, like that's what our breakage was doing too. And the great thing is the other party can't stop you from breaking the loan or breaking the swap, right? So at any moment, I'm just like, it's broken, right? You owe me
Mm-hmm.
$1 million. And it was just,
Yep.
you know, in hindsight, it looks like the smartest move ever, but we were just like, oh, we just want fixed rate loans, right? Like I'll pay 150 basis point premium. And Matt, I mentioned that we syndicate, right? From 2020 to 2022, I got a lot of questions from investors that were like, why are you paying 4.5% interest? Like so and so down the street, his loan's 3. And I'm like, I just want the predictability. I don't know where rates are going to go. Feels like they're really, really low. So in my opinion, the only way they can go is up. I never thought they would go up as fast as they did, but it put us in a really good position.
Yeah, and I think the thing that I've learned the most over the past 4 years is you have short-term business plans, which are fixing and flipping a house that's distressed. It's a 6-month business plan. If you hold that asset for longer than a year, you're probably doing something wrong in that situation. Then you've got longer-term business plans, which are, nope, this thing's kicking off great cash flow. We're just going to hold it and let inflation increase the rents and increase the overall value. You also have short term debt and long term debt products. And the biggest mismatch I see in the real estate environment today is people that financed long term business plans with short term debt. So,
Yeah.
to your point, hey, I'm buying a consistent, stable, cash flowing asset. I'm okay holding this thing for 10 years if I need to. I don't need to put 2-year debt on it. And I think I saw a lot of people get caught over the past 4 years saying, oh, we're just going to hold this thing for 7 years, but I've got a 3-year note on it. Well, then what are you going to do for the rest of the 4 years after that? And that's where they're getting caught in this environment.
Yeah, and I think our market. Um, we talked about Cincinnati a little bit in the beginning. For the first 14 years of my career, Cincinnati was labeled, from a national perspective, Cincinnati was labeled as a stagnant market. And then
Yeah,
in
flat.
the last 2 years, it's been labeled as a stable market. And frankly, it's the exact same market, right?
Yeah.
It just depends on what the Sun Belt is doing. Um, and so, Sun Belt was on fire forever. And so we were stagnant relative to the Sun Belt. But as we just continue to chug along at, 3% growth or whatever, and those markets are declining, now we look like a stable market. I'm okay with either, right? I just want consistency and predictability and really strong cash flow. But you had talked about, we kind of went down the debt path and talked about swaps, but operations, debt plus operations is like, that's where we feel really strong, is the combination of those two lead us to a extremely solid stream of cash flow.
Yep. Yep. And I just want to touch on your Cincinnati comment one real quick. A lot of people in 2020, again, were saying, hey, I need to go to the Sun Belt because Cincinnati is only growing 2% a year, 3% a year. That's horrible. Whereas, Florida's growing 9% a year and things like that. Well, now all of a sudden, Florida rents are declining at 5% a year for the past 3 years. And guess what? Cincinnati's 2.5%, 3%. And I think a part of that really, and I'd be interested to hear your perspective on this, is supply and demand. When you saw people starting to migrate to Florida, to Boise, Idaho, to Austin, Texas, to these ancillary markets, you saw a lot of cranes go in the air and shovels go into the ground. And that's usually a bad time to start investing in that market. The good time to start investing in that market is when Cincinnati is listed as a stagnant market. They're not putting a lot of shovels in the ground because of that. People continue to move there. Families continue to grow and expand. Jobs move there, et cetera. And now all of a sudden you've got a supply problem where there's not enough housing and you're holding the only supply.
Mm-hmm. Yeah, I mean, absorption is a huge component on pricing. So I would agree with that, and add that it's lots of other things too, right? So like affordability is a national issue. Cincinnati is one of the markets that I think at least stands up to solve that solution to some respect. Currently our average rental rate in Cincinnati is 17% of our average household income. That's
Wow.
extremely affordable. And what that tells me
Super
as
cheap.
an investor is it solves a problem that other markets have. And so, no, I don't think we'll be the next, Phoenix or Tampa or whatever. I don't think we'll see massive migration towards Cincinnati. But if you are a family that's stretched beyond your means and you want a good place to live that has job diversity and a good quality of life, like Cincinnati does solve that affordability issue. And equally as important as an investor is like, it shows me there is room to move the rents up, right? I'm in the business of increasing rents. If I look at Phoenix, and the average rent is, I don't know, I'm making this up, but 35, 40% of the average household income, is like, that's an unsustainable model. And to underwrite in a way that you think you're going to push rents is like, it's not going to work. But in my model, it works because the customer can actually pay it.
Yeah, I mean that's it. Like when I'm talking to people about passive investing in these sorts of things and they get a deal that comes across their desk, the first thing I say is, okay, is that market growing in population and jobs? The second thing I look is like, what's the average rent to household income for this particular product and this particular 3 to 5 mile radius? Because to your point, if it's anything starting to get above 35%, that's not sustainable. There's not a lot of room to continue to grow, or somebody's going to have to make a decision between groceries and home or housing. And if they stop paying and you have very hard eviction laws to get them out, now all of a sudden you've got a real big problem on your hands. So I'm glad you mentioned that around the average income to household rent.
Mm-hmm. Yeah.
Well, Jered, I want to switch us now to our last round. We call these the 4 toppings. Our first one is, what is your favorite book, or what is a book you've read recently that's given you a paradigm shift?
Paradigm shift. A book I read recently, I don't know if I'd call it a paradigm shift, but behind real estate, second thing that really interests me a lot is like health and wellness. So personal development, but specifically in like diet, nutrition, and exercise. And there's a book called Outlive by Peter Attia. And so it's one that's pretty in the weeds for those who like this topic, but I really enjoyed it because it was about reverse engineering not just your lifespan of like I want to live to 80 years old, but your health span, like how do I want to live within that time frame? And so for me being 34 today, like what do I need to be doing today to be able to, lift a grandchild above my head at 75 or be able to jog when I'm 80? Like what actions do I need to do considering at the average pace that muscle degenerates, right? So like it's pretty interesting.
All right. Do you know Brian Johnson? Are you kind of following him right now with what he's doing with the anti-aging stuff?
So I know the name. I would say that is not as much my interest as
Yeah.
like I'm not trying to live to 150 or 120 or whatever he's saying or forever. I'm trying to maximize like my quality of life within a normal time frame. So, call it 80, 90 years old. And
Yeah.
so, yeah, those guys like the biohackers and the ones who like really push the limits, I think they help us advance the science that I'll benefit from, but it's not really something that interests me too much.
Yeah. You're not going to go that far into the weeds. I would agree with you. It's like I've heard him on a couple podcasts and I'm like, that's super interesting for him to spend his life going to figure that out for my grandkids to figure
Yeah.
out. But I still love ice cream and a
Yeah. Yeah.
cheeseburger.
I want to eat some graters every once in a while and enjoy my
That's right.
life. I think
That's right.
I think I heard he drinks like olive oil every day is like his meal. And it's like, no, thank you.
Yeah. Yeah.
Anyway,
Our second question is, what is the best piece of advice you've ever received?
so I'll relate this so that it's a nugget for the audience. Um, I think a lot of people come to podcasts like yours or similar because we're all attracted to the financial returns and potentially uh, freedom that real estate investment can afford us. But I think what doesn't get enough attention is financial returns in real estate are supported by the on-site operations. And then even further, I don't think where it gets even less attention is on-site operations are supported by the people who work there. So a ton of what I do today as a business owner with 50 employees and CEO of our company is focused on our people. And that trickle up effect is we have great financial returns. But you get the wrong people in at your on-site level and it doesn't work. And so I would just say a good piece of advice, and it maybe it never wasn't given to me in these exact words, but financial returns are supported by on-site operations. On-site operations are supported by the people who work there. And as investors, if we remember that, I think we'll have a lot more success.
Yeah, I love it. I think when I'm talking to people about real estate and evaluating deals and coaching them through that and helping them look at that, the first place I start is the team. Who's on the team? What's their experience? Have they been through something like this before? Do they understand what's going on? There's going to be conflict and bad things that arise. You got to know that you have the right people that are driving the bus when those things happen.
Yep.
Our third topic is, what are you most proud of in your life?
So I kind of break lives into multiple pillars or components or buckets or whatever you want to call it, right? So I have a lot of pride in what we talked about today, but I also am a husband and a father and take tons of pride in how I show up to those aspects of my life too. I think what I'm proud of though that wraps all of those things together is that I'm dedicated to being a better version of myself in each of those. So sometimes I weight one too heavy and then I come back to the other, and it's that balancing act of life. But I always show up with the mindset of like, I do want to be a better version of myself in all of those aspects. And I'm really proud of that.
That's awesome. That's awesome. Our fourth and final one is, if you could sit down and eat a bowl of ice cream with anyone, dead or alive, who would it be and why?
All right. So you gave me a heads up before we started recording that this question was coming. So I had it like in the back of my head swirling around. And you know what? Like I talked about this designing your life. A lot of what I do building my company is designing the life that I want. And so as I think about that, I reflect on it, like my honest answer is like my wife and my kids. Right. So like, and it's a privilege that I actually get to do consistently. Right. It's not too profound to say like, I want to eat ice cream with my wife and my kids, but it's the thing that first popped into my head. Like, I don't need to go back in history and eat ice cream with someone who has no idea who I am. I would just like to spend time with them and share that, this moment in life with them, doing simple things like that.
Best answer we've heard so far. I recently came back from a trip to Paris at the Olympics with the wife and kids, and we ate a bunch of ice cream, and that's kind of got me thinking about that too. Like, how do you replace this moment? We were at Disney doing it, Disney Paris, and it's like, man, seeing them experience Disney for the first time, eating ice cream, it's a wonderful moment. So probably one of the best answers we've had so far on the show.
Thank you.
Jered, fantastic conversation. If our listeners wanted to reach out to you, learn more about you or what you've got going on, where is the best place we could point them?
So I'm on most of the socials, but snscapitalgroup.com is our website, and there's opportunities to reach out to me through that, and I'll be happy to help anyone any way I can.
Perfect. We will link those in the show notes. And then Jered, thanks for coming on.
Yeah, Matt, I appreciate the opportunity to share a little bit about my story. So thanks.
Thank you for listening to Ice Cream with Investors. If you like what we serve you here, it would mean the world to me if you would like, subscribe, and leave a review on your favorite podcast app.